Hi guys! We are on the third session of our full basic accounting course. And for today's topic, we will discuss the accounts and journal entries for beginners. Are you ready to start? Alright, here is the flow of our tutorial. So we will start from the financial statements. So we will dissect that and check the line items or the classification of each transactions, which might be cash and cash equivalents, receivables, inventory, property and equipment, or trade and other payables, and others. Alright, so after checking on the line items, we will look into the accounts, which might include cash in bank, cash on hand, short-term investments, and others. After checking on the accounts and line items, we will now check the accounts, which consist of the transactions from each accounts. And then from there, after we understand the account, we will now look into the journal entries, which is the essential topic that we are discussing today. Alright, let's go back to the accounting equation. So as you remember, the accounting equation works like this. So the accounting equation is equal to assets equals to liabilities plus equity. So asset is what the company owns, while the liabilities and equity are what the company owes. So we will start by presenting the statement of financial position as discussed on the first slide. Okay? So here is the financial position of Mish Company as of April 30, 2022. As you can see, it is divided into current assets, non-current assets, current liabilities, non-current liabilities, share capital, and retained earnings. And then from there, from current assets, you can see the line items, which are cash and cash equivalents amounting to 50 currency units, and then receivables amounting to 30 currency units, inventories amounting to 40 currency units, and so on. This statement of financial position is very important so that we can understand later the line items, the accounts, and the journal entries. But exactly, what is the statement of financial position? So the statement of financial position is another term for the balance sheet. That statement lists the assets, liabilities, and equity of an organization as of the report date. With that, it provides a view of the financial condition of a business as of a specific date. Going back to the statement of financial position, we will now look into a sample line item, which is cash and cash equivalent. So as you can see, the cash and cash equivalents might be composed of many accounts, which may be cash in bank, cash on hand, and short-term investments. So for this example, the cash in bank amounts to 20 currency units, the cash on hand amounts to 10 currency units, the short-term investments account to 20 currency units, which totals to 50 currency units. So the total currency units equates to the total cash and cash equivalents, which is a line item in the statement of financial position. But exactly, what is an account? What is cash in bank? What is cash on hand? What is short-term investment? So this account is a record in an accounting system that tracks the financial activities of a specific asset, liability, equity, revenue, or expense. So from that account, there are many transactions that may have transpired during the month or during the period. For example, the cash on bank, which we are illustrating right now. The beginning balance of that cash is 100 currency units, but there is a collection from customer amounting to 60 currency units. And then there is a collection also from the sale of scraps. So now, the total of the account, the cash and cash equivalent, or the cash in bank, is 180 currency units. And also, there is a deduction of cash. For example, there is a payment of rent amounting to 30 currency units, or payment to supplier amounting to 40 currency units, and payment for interest amounting to 90 currency units. So total of that is 160 currency units, which the ending balance will result to the 20 currency units. And as you can see, that amount is the same with the cash and bank in the balances that we are presenting on the previous slide. So as you can see, our topic is all about discussing from the financial statement to line items to accounts to T accounts and journal entries. So now, the cash equivalent line item here is composed of cash and bank, cash on hand, and others. And from there, the cash and bank, the cash on hand, the short-term investment will consist of many transactions which are embedded into the T account. Okay. But how will we know when to debit and credit? So here is the secret formula. We need to understand the normal balance of each accounts. Okay. And the normal balance of accounts for assets, withdrawals, and expenses are debit, while the liabilities, owner's capital, and income are on credit. So basically, when the normal balance is debit, the increases are recorded by debit, while if the normal balance is credit, the increases are recorded by credit. Okay? So here is the illustration of the normal balance of accounts. So assets is on the debit, while liabilities and equity are on credit. Okay? So we will now illustrate a sample transaction so that we can understand the normal balance and the increases or decreases in an account. So here is a sample cash and bank. Okay? So as you can see, the beginning amount is 100 currency units, and it is added by the collection from customer amounting to 60 currency units. And then there's a collection from sale of scrap amounting to 20 currency units. So as you can see, all the additions are placed on the debit side, while the deductions for the payment of rent, payment to suppliers, payment for interest are on the credit side, since it is a deduction to assets, which is cash in bank. Okay? So now let's take a look on another example. The company purchased and credit an inventory amounting to 90 currency units. So the transaction will work like this. Since it is an inventory, an asset, we will add a 90 currency units to the debit side of inventory. And then, we will credit the accounts payable amounting to 90 currency units. As you can see, the total of the inventory and the accounts payable, or the total assets, equals the total liabilities plus equity is 90 currency units, and the equation is balanced. So for every debit, there is a corresponding credit, and that is what we call the double entry bookkeeping. Double entry bookkeeping is the method of recording transactions where for every business transaction, an entry is recorded in at least two accounts as a debit or credit. So in a double entry system, the amounts recorded as debits must be equal to the amounts recorded as credits. Okay? Let's take a look on another example. The company already paid the supplier for the inventory amounting to 90 currency units. So now, we will understand this transaction by obtaining what did the company do. It paid the supplier, so there is a corresponding decrease in cash amounting to 90 currency units, and then there is a corresponding decrease in accounts payable amounting to currency units. With this, the transaction is again balanced since we have done credit on the other side and debit on the other side. So now another example. The company purchased in credit an inventory amounting to 90 currency units. So the inventory is on debit since it is purchased in credit, while the accounts payable is on credit since there's an addition to the accounts payable. So doing this on a journal entry, the debit is on the inventory amounting to 90 currency units and credit on accounts payable amounting to 90 currency units. With that, we already understand how to prepare a journal entry. We just obtain the inventory here, the debit here, and then we just obtain the credit here, which is the 90 currency units. So we'll just obtain it in the T account, and then we can already understand how journal entries work. Alright? And to better understand how the journal entries work, we will also need to know the typical accounts used. So let's start with assets. And the current assets may include cash, which are coins, currency, checks, and bank deposits. Cash equivalents, which may include highly liquid investments such as the 3 months deposit. Notes receivable, which are written pledge that customer will pay on a given date. And then accounts receivable, which are claims from customers on sale of goods and services. And then another example of a typical account used are inventories, which are assets held for sale in the ordinary course of business or in the process of production for such sale in the form of materials and supplies to be consumed in the production process or in the rendering of services. And then also prepaid expenses, which are expenses paid by the company in advance. And then non-current assets, which may include property, plant, and equipment, which are assets held for use in production of goods and services, for rental to others or administrative purposes, which are expected to be used by more than one period. And then accumulated depreciation, which is a contra account, and is the sum of periodic depreciations each period. Okay. And then we have also intangible assets, which are identifiable non-monetary assets with a physical substance, such as goodwill, patents, copyrights, and others. And then liabilities, which may include accounts payable, which amounts due from suppliers. And notes payable, which the business, the maker of the notes and promises to pay in a given date. And then we also have accrued liabilities, which are amounts owed to others for unpaid expenses. And unearned revenue from payment received from customers before providing the goods and services. And then current portion of long-term debt, the portion of mortgage notes, bonds, and other long-term debts which are already due 1 year after the reporting date. And then from the non-current liabilities, there are mortgage payable, long-term debt which is collateral. And also, the typical account used may include bonds payable, which is a substantial sum of money from various lenders using bonds, which the bond is a contract between the issuer and the lender, specifying the terms of repayment and the related interest. And then capital, which is used to record investments of the owner, and also the income for the year and withdrawals are closed thereto. And then, and then expenses, which include cost of sales, the cost incurred to produce the products for sale to customers, aka cost of goods sold, and then salaries and wages expense, which are costs paid for salaries of employees and other related benefits, telecommunications, which electricity, fuel, and water, alright, and then rent expense, which is the cost for office space rent and equipment and other rentals. Supplies expense, which are office supplies used daily in the business. Insurance expense, which are premiums paid on health, building, or other property insurance coverages. Depreciation, which are allocation of expense of a tangible non-current asset. Uncollectible accounts expense, which are receivables estimated to be doubtful of collection. Interest expense, which are interest from loans. So now, let's go to the practice questions to better understand how to prepare the journal entries. So here is a sample transaction from Mish Company. Alright. So Mish started her business last March 1, 2022 by depositing 100 currency units in the company's bank statement. So now, we will prepare the financial transaction worksheet, and then from there, we will prepare the T accounts and the journal entry. So let's identify first the related transaction. So what is deposited? It is cash. So we will indicate a cash amounting to 100,000 currency units on the assets, and then from there, we will identify the related credit, which is the capital. So since she started her business, he deposited an investment amounting to 100,000 currency unit. Okay, so as you can see, the total assets is equal to the total liabilities and equity, which is 100,000 currency units, and the transaction is balanced. Okay, but how do we illustrate this on the T account? So since it is an addition to cash, we will debit investment, we will debit cash, which is an investment, and we will credit the equity, which is also an investment. So this investment is an addition to the cash and an addition also to the equity. So how do we prepare the journal entry? So we just get the debit here, which is cash, debit cash amounting to 100,000 currency units, and then credit the Mish capital amounting to 100,000 currency units. So as you can see, we just obtained here the debit and obtained here the credit. So now, by doing this, we already have the journal entry for this transaction. So next example. So now, Mish Company purchased an inventory amounting to 1 to 10,000 currency units payable on April 2, 2002. So we will understand this transaction by obtaining the details, the relevant details. So what did Mish Company do? They purchased an inventory. So we will debit an inventory since it is an addition to assets amounting to 10,000 currency units. So add here an inventory and a debit, okay? And then we will add also the liabilities since as mentioned on the sentence is not yet paid, okay? So since it is an addition to liabilities, it is a positive 10,000 currency units. And as you can see, the total assets is equal to total liabilities and equity again. Okay. So now, we will indicate it on the T account. So let's add here an inventory amounting to 10,000 currency units, and then add a credit to the accounts payable amounting to 10,000 currency units. And then, since we are already done with the T accounts, we can now prepare the journal entry, which is a debit to the inventory amounting to 10,000 currency units and a credit to the accounts payable amounting to 10,000 currency units. So very easy, guys, right? Okay, I think we can go now to the next example. So the third transaction is all about Mish Company already paid the vendor last April 22, 2022. So now, since it is already a payment, there is a deduction now to cash and liabilities. So we will indicate here a negative 10,000 to assets, specifically to cash, and then a negative 10,000 here to the liabilities, which is specifically to accounts payable. And as you can see, the equation is now again balanced. Okay? So we will indicate now the T accounts for this transaction. Since it is a deduction to cash, we will credit cash amounting to 10,000 currency units, and since it is a deduction also to liabilities, we will debit the liabilities amounting to 10,000 currency units. So now, we can now prepare the journal entry. So we just obtain here the debit side, which is the accounts payable amounting to 10,000 currency units, and the credit side, which is cash amount to 10,000 currency units. Alright, I believe that you already understand how the T accounts and journal entries work. So our next topic is all about the accounting cycle. Don't forget to subscribe, guys, and hit the notification bell. Goodbye. Thank you.